Glyn, following on from a difficult May, how are markets faring in June?
Well, it was an interesting month. In the first few days of June, the pattern of May continued. The uncertainties, the fears over potential disorderly Greek exit from the Eurozone, they continued into the first few days of June, and markets were down a few percent within literally a few days. But intriguingly, sentiment began to improve a little bit as the month wore on, and surprisingly, by the end of the month, we actually had a good result. The MSCI World Index was up by about 5% at the end of the month, virtually all of which took place on the last day of the month.
There are a number of distinct but related events which probably led to that turn in sentiment. The first one being the Spanish banks.
Yep.
What was the outcome of those discussions?
Well, Spain, as everybody expected, formally applied to the Eurozone for a bailout to support the Spanish banks. They were looking for 100 billion euros, a bigger number than most market participants thought, and the fact they went to the other Eurozone members and sought that amount was initially seen as a positive step by the markets, and the markets began to rally. But then the poorly defined terms of the bailout package led to a lot of concern among investors, the principal ones being that the money was going to be lent directly to the Spanish government rather than directly to the banks. So it added to Spanish public debt, which is a real fear of markets, would take Spanish debt to something like 90% of GDP. And then there was a real concern that existing bondholders would be subordinated to this new lending. And that's what really triggered a concern in markets and pushed Spanish bond yields through the 7% level. And 7%, as we've said before, is a critical level in the Eurozone, because it's the level at which people rather feel that it's impossible to sustain sort of borrowing on a long-term basis. So that became a real issue in markets. However, the other principal concern, which was the Greek election on June the 17th, the second election, of course, in the space of a few weeks, that other principal concern was that the opinion polls were suggesting that the left-wing Socialist Party would actually reject the bailout terms that had already been agreed, and the end result would be a disorderly exit of Greece from the Eurozone, and therefore a disorderly default. But as we got closer to that day, opinion polls began to shift. It was evident that the vast majority of Greeks didn't want to pull out of the euro, and then finally on the day, the Socialists didn't win a majority. It was actually the centre-right party, the New Democracy Party, that won a majority, was able to form a government, and therefore the risk of an exit of Greece from the euro and a disorderly default was certainly removed, at least in the short term, for the time being. And those factors definitely improved sentiment in the markets. The markets began to tick up a little bit, despite this big uncertainty about Spain. And of course, underpinning all of this, remember markets had fallen between 10 and 20% in the previous 2 or 3 months. There were some pretty good valuations in equity markets.
While we're on the subject of valuations, Glyn, there are pockets of opportunity still around in the markets. What's been most interesting in June?
Well, the things that have moved most of all, interestingly, Japan has been a standout performer. We have felt that Japanese valuations are really very attractive. We all know the difficulties that Japan is. It's a long-term period of deflation and very slow growth, but it is a very cheap market. Japan was the best performing market, rose over 7% in the month. Some of the more cyclical stocks also bounced back, although we remain concerned about that, because the clear evidence from economies, be it the US, China, Europe obviously, UK, is that there's been a marked slowdown in growth in recent weeks. Whatever you look at, whether it's manufacturing sector, purchasing managers, indices, consumer confidence, all are pointing to some slowdown in growth. So we're concerned about getting too carried away by these cyclical stocks. This is a short-term bounce in our view. We are still worried about the commodity markets. China's been the big buyer of commodities in recent years, and the Chinese economy is definitely going into a structural slowdown, becoming less commodity intensive over the next several years. So this sort of super cycle of commodities is over. So we still feel it's appropriate and absolutely right to invest heavily in the more defensive areas of the markets, the consumer staples, the good franchise companies, the companies with strong balance sheets that will weather this storm that we're in. So we haven't changed our view on that, and we still stick to those areas. One other comment on this incident is that emerging markets didn't do as well as developed markets in June. I think for these reasons, that this slowdown that's going on in China and other emerging markets is a real issue for investors. So emerging markets rallied, but not by as much as the developed market index.
Valuations are clearly important at the moment. They don't, as you suggested, exist in isolation from economics, but the final part of the puzzle really is still political. We touched on Europe.
Yep.
But overall, there were material changes by the end of the month,
yes,
largely from Germany.
Yes. Well, I think there was a very significant move there. The key event was right at the end of the month, on the last couple of days of the month. There was the 19th EU Summit of Leaders, the 19th since this debt crisis started a couple of years ago in Europe. All of them to date have been pretty disappointing in terms of their outcome. Too little, too late, not really addressing the big structural problems that need to be addressed. And I think investor expectations going into this summit were very low. Now, in the event, there was a real move, in particular on the part of the Germans. And the things that were critical were, first of all, there was German support for a modest growth package, which would add about 1% to GDP over time. Quite small, but it was a move in that direction for the first time. And then, much more importantly, the critical events were that the European Union effectively allowed central funds of the Eurozone to go directly to banks to bail them out, rather than being siphoned through government. So direct recapitalisation of the banks for the first time, in return for central supervision of those banks by the ECB. That was not expected by investors. It came earlier than people thought, and that was definitely a very good move. And then the other key thing was that the Eurozone agreed that any bailout funds would not result in a subordination of existing debt. So clearly good news for Spain, potentially good news for other countries that have been bailed out too. So these were big moves in the right direction, and we shouldn't underestimate that. And as soon as the market picked up on this, we had a very big rally. In fact, the MSCI World Index rallied 3% on the last day of the month, represented 60% of its gain for the month. Europe was up over 5% on the day, and into July we've seen a little bit of that rally continuing still. And although there's still a long way to go in Europe, you could argue that these were further mini steps on the way to a full banking union and a full monetary and fiscal union. Long way to go, but moves in the right direction, and the euro has lived to fight another day.
Commodities have been soft recently on the basis of growth worries in the developed world and the developing world. How did we fare in that market in June?
Well, commodities were a mixed bag. Industrial commodities did rally, but only a little bit. And I think there was still this overhang of concern that the global economy is clearly slowed down. We're now looking for 2.5% growth over the course of the next 12 months or so, and that sort of pattern of low growth is going to continue for a long time. A clear reduction in demand from China, and then we saw the oil price continuing to fall. In the course of June, the oil price fell by 10 or 11%, and it's now down by the end of the month, it's down by about 30% from peak levels. A combination of Saudi Arabia pumping at pretty much record levels, over 10 million barrels a day, and a weakening off in demand. So far this month there has been a bounce back in the oil price, but it's still well down from the highs of earlier this year. And remember, that reduction in price is equivalent to a tax cut for consumers. It's coming through at the pumps quickly and does represent a boost to consumer sentiment and potentially to consumer spending. So that is unequivocally good news, this sort of reduction in the oil price and falling commodity prices.
So positive shocks towards the end of the month out of
Yes.
Europe. better news for the consumer, lower inflationary pressures perhaps. What can we
Agreed.
expect next to happen?
Well, we're not out of the woods. We've got sort of competing pulls in the markets. Yes, there's been some good news in the Eurozone, but there is a very long way to go. We're going to get lots of bumps on the way. We are by no means near a full fiscal or banking union. There's a lot of work to be done. And there are lots of risks still overhanging the Eurozone with the amount of debt that's got to be repaid, the amount of austerity that's required in peripheral Europe to regain competitiveness against the core, and particularly Germany. So we're going to see plenty of scares on the way there, and certainly continuing very slow growth in Europe, recession of course in peripheral Europe. We also have the concerns about growth in China, definitely a slowdown there, structural slowdown I think. The US has been doing okay, but the US of course has got its own fiscal consolidation to come once the election's out of the way in November, so we will see some cuts in fiscal spending, some slowdown in the economy there. So you've got those sort of negative factors, but as I mentioned earlier, the euro has survived so far. There hasn't been any disorderly default. There have been some positive steps taken. Valuations remain good in equity markets, in some cases compelling, providing lots of support, and we've had this better news on inflation. So I think we'll continue to get these sort of competing forces pulling one way or the other. We'll continue to get volatility, and what we will do in our portfolios is exactly what we have been doing, using these periods of weakness such as we saw in May to add to our equity positions, because we still believe that's where we're going to get the best returns over the medium term.
Lower growth rates, arguably, lowering inflation, what does that speak to in terms of monetary policy in the developed world?
Well, I think the other important factor we've not touched upon is the moves by central banks, the indications from central banks, the big ones being the Federal Reserve, the Bank of England and the ECB, that they will make moves to ease monetary policy further, given this slowdown in activity, given the problems we know about debt and sluggish growth. So I've no doubt that we will get further shifts, easing of monetary policy. The Fed has already extended Operation Twist, buying of long-term securities against short-term ones. The ECB, the European Central Bank, is meeting today. I think they'll cut interest rates by 0.25%. I think they will in due course resort to another long-term refinancing operation, providing liquidity to markets. The Bank of England is also meeting today. I think there'll be another round, a third round of quantitative easing, where the bank will actually print money to buy government debt. So the market again has been looking forward to these injections of liquidity, and also provides support to markets. So I think we will definitely get that both today and in coming months. We do have the backstop of those big central banks providing huge amounts of liquidity, and that will definitely support markets in coming months.
Okay. Thanks, Glyn.